Rolls-Royce shares hit 1,424p this week, a 52-week high, up 9% in 3 trading sessions. Two separate events drove the move, and they point in opposite directions for the investment case. The bottleneck is this: the market priced both catalysts as bullish simultaneously, but they underwrite different versions of the company. Sweden's Vattenfall selected Rolls-Royce SMR to build the country's first new nuclear reactor in over 40 years. That is a structural, multi-decade contract, the third SMR commitment after the UK and Czech Republic. Simultaneously, the US-Iran peace deal reduced the near-term risk to international air travel, engine flying hours, and disrupted shipping routes. Those are two different money flows entering the same stock in the same week. The Iran relief reprices near-term aviation earnings risk. It pulls the defense and geopolitical premium that had been embedded in the share price back out. The SMR win prices in long-cycle nuclear revenue that, by management's own disclosure, generates no recurring aftermarket cash until the mid-2030s. One catalyst compresses the risk premium that helped power the run. The other replaces it with a revenue stream a decade away. A stock at a 52-week high with a 19.9 price-to-earnings ratio is pricing one of these more heavily than the other. The question every holder and every watchlist candidate must answer is, which thesis is the market actually paying for, and what happens when it has to let go of the other one?
The Sweden Win confirms momentum, but the financial architecture is not yet disclosed. 3 SMRs will be deployed on the Vero Peninsula, and at roughly £2.5 billion per unit, this is a multi-billion-pound program. But no margin, no revenue schedule, and no equity participation terms have been announced. That last point is what matters most to the valuation. In the Czech Republic deal, ČEZ Group took an equity stake in the SMR business, not just a supply contract. If Viterberg Kraft, the Vattenfall Industria Kraft joint venture, does the same in Sweden, that dilutes Rolls-Royce's roughly 58% ownership of the SMR entity. CEO Tufan Ergin-Bilgic called it evidence of significant future growth opportunities and first-mover advantage in a growing market. That framing treats the pipeline as the value driver: UK, Czech Republic, Sweden, with Germany potentially next. But analysts at Interactive Investor flagged this week that valuations look stretched for the defense and engineering sector, with Rolls-Royce trading well above the wider FTSE 100 average. The buried assumption in the bull case is that the SMR pipeline win rate translates into margin-positive contracts without equity giveaways. If each new country entry requires a ČEZ-style equity for contract trade, the ownership that investors are buying today is progressively diluted across the very revenue they expect to receive. That is the mechanism the surface reading does not account for. The first-mover advantage and the equity dilution risk are the same transaction, not separate ones.
There is a genuine counter case. The PE of 19.9 is not stretched for a company that is re-rated from near bankruptcy to a £100 billion market cap by actually delivering cost cuts, margin expansion, and a growing power systems division. Civil flight hours rebounded strongly post-pandemic, and defense budgets across Europe have surged. EU spending expected to exceed €392 billion this year, up from €221 billion in 2021. That structural tailwind is real, and the Iran deal does not eliminate it. It merely takes some urgency out of the geopolitical premium embedded in the share price today. But the Iran relief is the variable that holds the most immediate repricing power. If the ceasefire holds and aviation risk continues to unwind, the near-term earnings support for the share price softens before the SMR recurring revenue begins, and that gap is roughly a decade wide. For holders, the monitoring variable is not the share price, it is the equity participation terms of the Sweden deal when disclosed. If Viterberg Kraft takes equity, the SMR ownership stake shrinks, and the long-cycle revenue that justified holding through a 52-week high is worth less per share than the market is pricing today. For watchlist candidates, the entry trigger is not Germany speculation or a further Iran deal step. It is the H2 2026 UK defense budget review. If the new defense secretary secures funding above the £13.5 billion floor toward the £18 billion gap previously flagged, the structural defense order book expands and provides a nearer-term revenue anchor that does not depend on the SMR timeline. The risk that breaks the read: if Iran relief accelerates, the aviation premium unwinds before UK defense spending is confirmed, and Rolls-Royce is left holding a stock price built on two catalysts, one of which is deflating and one that does not pay out for a decade. Watch the Sweden equity terms first, the H2 defense review second. Everything else is noise. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.